Well, welcome everyone. Thank you for being here. I do want to mention one thing for the people that are just arriving. I do a 5-minute segment before for the early arrivers so that we don't just sit here in silence. This week I talked about how the American Wild West was, so if it had not been so crime-ridden, we might not have had computers. Next week I'll talk about how did IBM get into the computer business. So that's, if you want to arrive a few minutes early, I'll be talking about that. And there's no reason you have to arrive early, but I have little tidbits to share.
We just like it when they do.
So anyway, let's get started. And I think, are we seeing that?
Looks good, Mike. Yep, looks good.
So you've probably seen the picture. Xi Jinping flanked by Kim Jong-un and Vladimir Putin. You'll notice that the Modi from India was there. You'll notice a whole group of leaders of countries. Those are all the leaders of different countries. It was the meeting in Shanghai of the Shanghai Organization for Cooperation. It's been around for 20 years, started in 1996 with just 5 countries, but has now grown to over 20 that are members. It has 2 observers and 4 guest countries. Actually, I said 20, it's 10. China, Kazakhstan, Kyrgyzstan, Tajikistan, Uzbekistan, Pakistan, all the Stan countries except for Afghanistan, Russia, India, Iran, Belarus, and reaching down, you have attendees from Brazil, you have attendees from Africa as well at times. You have Turkey, Myanmar, Nepal, Indonesia, Malaysia, the Maldives. It was set up originally to talk about border disputes, but that's evolved beyond that. It's evolved into a group that talks now and has been talking for the last 8 or 10 years about an alternative currency to the US dollar. They're also talking about everything that's going on in the world. China, of course, wants to replace the United States as the most dominant economic and military force in the world. This is part of that thing. This is part of that strategy. This is one of the most incredible things happening right now in terms of what is going forward in world economics. You know, China's done two opposing things. They're trying to negotiate free trade agreements with countries in Europe and South America. They're also dumping in the market. Some companies in China, with the tariffs that the United States has imposed, are dumping jeans for as little as 80 cents on the dollar. Buy a pair of jeans for 80 cents on the dollar. We want to impose tariffs on China, but those companies are caught in a squeeze. And some of these countries are developing websites to talk about American products and alternatives you can get not from the United States. Even our closest trading partners, Canada and Mexico, have things going on. I don't know if you've heard the new slogan from Canada, or it's not so new, it's been going this year. It's Buy Canadian, Buy American. They spell that B-U-Y, Canadian, B-Y-E, American. So the United States is a huge market, but we're only a quarter of the world's GDP. We're only a quarter. There was a time not that many years ago when we were 50%. We dominated the market. We were only as large as that group in that picture. That's where we are. That picture also represents 42% of the world's population. That's a significant buying group. And as that group moves from subsistence into consumption, that 24% has a significant probability of moving up. That's what's going on in the world. You know, the United States is still a huge market, but we're not the only market in the world. Add Canada and Mexico, and that bloc represents 19% of world GDP. Closest trading partners, now they're looking to sign agreements with the Shanghai Organization Cooperation and the EU bypassing the US. That's, when you look at what was going on, if you look at the NATO countries that are talking about building out their own defenses, excluding the United States or bypassing the United States. The best fighter jet in the world is the United States F-22, but the EU countries are beginning to switch to the Eurofighter, the Typhoon. Starlink dominates the world satellite market with over 7,000 satellites. There's a shift and a push for OneWeb, the French satellite company that has just 700 satellites, to put up a whole lot more to compete with Starlink. It's happening worldwide, but people are moving away from dependence on the US and moving in their own direction. That puts a lot of pressure on the United States and the US companies. And if you look at what's going on in this country, we have 26% of worldwide GDP, the rest of the world's 74%. But the world is changing. The world is truly changing. And if you look at what's happening in the United States, the lower 2/3 usually spends 100% of their paychecks. It's the upper third that puts away money. And when you look at the lower 2/3, they spend their money, and by the time the old saying, the butcher pays the baker, pays the candlestick maker, there's a multiplier effect. For every dollar they spend, it's really $2.50 or $3 or $4 that gets put into the market. And there's a shift going on, because while the upper third is doing well, the lower 2/3 are not doing well. If you exclude 2020 and look at what's gone on, we've gone 17 years in the stock market without a real correction. It goes back to 2008, 2009, before when there was a real correction. The Lehman Brothers, when it died in September of 2008 and the crisis began, the traders who are now in their 20s and 30s and even into their 40s have never been through a market crash, a market crisis. And if you look at what's going on, it's the top 10% of this country that's responsible for about 50% of the consumption, of the consumer spending. And consumer spending is driving the economy right now. The economy numbers came out, the revision for the second quarter showed that the economy is growing at a very rapid rate. Although the previous quarter we showed less than that. Less? If you take the two together, it's probably an average. So, but it's the top 10% who account for 50%. The top third account for a lot more. And right now, 30% of wealth for Americans is in the stock market. What happens if that shifts down? What happens to the spending of the top 1/3? What happens to the spending of the top 10%? Will they continue to spend? If they don't continue to spend, that puts a significant risk for the US market. And this, this is just a repeat of that. It's the top third that's really driving the top 10%, and the top third that's really driving the market. If you look, in addition to all of that that's going on, the trade disruption caused by the tariffs. Talked about the SOC and the meeting there. China used to buy 25% of the soybeans produced. Now This year, they're buying 0. And it's a template for understanding what's going on in the trade wars. It's happening with products from Mexico. It's happening with higher prices, with products from Canada, higher prices, and the avoidance of products produced in the US. There's a disruption going on. There's a new world order that's happening on the economic scale. And that's going to impact the stock market. It's going to impact the economy. Are you ready for that? And currency. I mentioned the SOC. Since the early 2000s, they've been trying to develop an alternative currency. Right now, the US dollar is the most recognized currency in the world. US treasuries are traded 24 hours, 7 days a week, 365 days of the year. It's the safest treasury. It's the safest security in the world, or considered to be. Maybe that'll change with the shutdown of the government, but probably not. The US Treasury, the US dollar is considered the safest thing to have. But there's a move up front. It's been growing and it's continuing to happen. There was a time when you needed the currency exchange companies, the Thomas Cooks of the world, if you remember Thomas Cook. They set up the exchange rate between the dollar and the franc, or the dollar and the German mark, or later the dollar and the euro, the dollar and the Chinese yuan, the dollar and the peso, the dollar and whatever, and all those different currencies. Today, we can easily do the exchange rate just on a simple little phone that we carry in our pocket. It's a computer, and it has all the exchange rates. The Thomas Cooks have essentially disappeared. Most of the contracts that are written in the world, most of the contracts are written in dollars, but there's a growing trend to use other currencies. That means the dollar gets squeezed down. Add to all that, there's a brain drain that's taking place. After World War II, when the Germans were defeated, Werner von Braun came to the US, the rocket scientist. Albert Einstein moved to the US. Many, many others used to the US. Prior to the end of World War II, all the planes that were built in the US and in the world had the wings straight out. It was the Germans who realized that by doing the swept wings, that it improved the efficiency and the operation and cut the fuel consumption of aircraft. And it was the Germans and moving that technology from Germany to the US that led Boeing to begin to make the 727 with swept wings rather than the planes like the Corvair 580 with the straight out wings. There's now a brain drain going the other way. There's a move for scientists to leave this country and go away. I have a personal story to tell. I have a granddaughter that's a senior at UCLA, studying in Sweden this year. She's pretty intelligent. She got an internship in the summer in a lab. She's majoring in biology, actually, biophysics. There were something like 400 students that started in a class, and I think they're down to less than 20. It's a very difficult course. She was in a lab. She created a virus that shut down a bad virus. Awfully proud of her doing that. But in talking to her, her outlook, along with a lot of her contemporaries, is she doesn't see doing science in the United States as for her future career. France is already developing a $250 million recruiting fund to recruit established sciences. The layoffs in the CDC and the National Institute of Health, those people are being recruited just just as we recruited Werner von Braun and just as we recruited Einstein, things are moving away. And when you consider all the number of grants that have been canceled, childhood survival rates in low resource hospitals, improving cancer immunotherapy, breast cancer research, those scientists are being recruited away from the US because their grants have been terminated. They're being recruited overseas. That's where things are going. You know, if you look at, I always make the comparison between what's happening with China and what's happening with the United States. And you can picture it allegorically as China. If you're looking at their cultivation and growing things, you see rows, maybe beans, maybe lettuce, whatever it is, straight rows, immaculate, no weeds, everything is well watered, well plumbed, everything is perfect. If you look at the United States in the same terms, you can look at the United States as a rainforest. There's weeds everywhere, there's plants everywhere, there's no sense or reason of what's going on. And that's exaggerated some, but we have an entrepreneurial spirit that has led to a time in which we do things that are not imaginable. I don't know. We have entrepreneurs that are willing to fail, and the phrase they use is to fail forward. So if at first you don't succeed, try trying again. That's been the culture of US entrepreneurs. Are we going to be spreading that across the world? Maybe. You know, if you look at what's happening, we're moving away. We may be losing the energy war and climate change. Our president addressed the United Nations and called climate change a hoax. No, it's not a hoax. It's real. We're pushing fossil fuels. The rest of the world is pushing green energy and green focus. Are we losing the energy war? Are we losing the climate change? I raise the question because this is a central question that we're going to be talking about next Thursday in the workshop. Are we losing the energy war amid climate change? And what is the impact on the economy and on the world when we're doing that? I think it's very significant. At the same time, if you look at where commodities are today, commodities generally, you end up with a super cycle of commodities in certain countries. For countries where the per capita income is lower than 4,000 per capita per year, they're not consuming many of the commodities we think about. If you look at countries that have a per capita income of over 20,000 a year, they've already built out their roads and their airports, and they've already built out a lot of their agricultural things and their commodity, using their steel and using their different commodities. But there's 55 countries that represent 23% of the world's GDP, that as they ramp up, as they move from being subsistence to actually being a commercial or a consumption society, they're going to consume a lot of commodities, and commodities are going to flow that way. Commodity prices are going to be under pressure as they move that way. We're going to see commodity prices rising. We're going to see, and with the trade wars that are going on, we're seeing commodities like groceries, like tomatoes, like cheeses, like my wife mentioned that she got some Madagascar from a jar of vanilla from Madagascar that's she paid $74 for. It used to be 7. So, I mean, prices are increasing. Yep, don't have to go to, look at what's happening at the grocery store. Prices are increasing, and there's a tendency for prices to rise like a rocket and come down like a feather. The only thing that we're seeing are some of the energy prices down, but food prices are up and the prices of consumable goods are up. All of that will add to a condition which we see coming of stagflation. We see prices increasing, and while the Fed is lowering interest rates, that was the same thing that happened at the beginning of the 1970s. William McChesney Martin, who was chairman of the Federal Reserve through Truman, Eisenhower, Kennedy, and Johnson, and at the beginning of the Nixon presidency, was replaced by Arthur Burns. Martin had been raising rates. Burns came in and began to lower rates. Even as inflation was taking off, inflation had tipped up at the end of the 60s. Martin was raising interest rates. Inflation was beginning to taper back off again. It had reached about 6% in 67 or 68 and had tapered off in the 70s, had begun to taper off. Arthur Burns came in and lowered the interest rate. You had the great grain robbery, which I talked about a couple of weeks ago. You had the OPEC doing their oil embargo, and prices took off. But it wasn't just the prices of commodities. Wages took off as well. So you had inflation taking off in the 60s and 70s, drifting down at the end of the 60s, and then exploding upward in the beginning of the 70s, the oil embargo. But you also had wages increasing. And as Volcker came in, Paul Volcker was appointed and became chairman of the Federal Reserve following Arthur Burns. He began to raise interest rates. The reason that Burns was lowering rates as Nixon wanted rates lower was because a recession was beginning to take place. By the early 70s, we had a recession. Unemployment would rise to over 10%, to the same level we saw in 2008, 2009. Unemployment was at that level, but prices were increasing. The consumer price index was reaching close to double digits. So you had prices increasing and unemployment increasing, putting us into what was called stagflation. If you look at the last time we went through a market crisis in the US in 2008, 2009, it's been 17 years if you exclude the 2020 time period, which saw the market dip and then recover completely within 162 days. Fastest recovery ever. If you take that away, the traders who are in their 20s and 30s and even into their early 40s have never experienced a really down market. They have no idea on how to react. They've never been through it. How will they react to that? Stagflation. It's one thing to know and read about in the books. We've all read about the Great Depression. We know what went on, kind of what went on. But those who are old enough to remember the 2008, 2009, and I think most of the people in this workshop remember that. Remember a time when people were worried about losing their house. Everybody knew somebody who was being foreclosed out of their house or losing their house, losing their job. That is what 10% unemployment does. And we have a lot of money managers, a lot of analysts who've never experienced that at all. And what we're going through is not just a market downturn, but inflation as well. There's no way to say that's for sure a kind of thing that's going on, but the probability is that it will be happening. That's where we are. And what we saw in the 1970s, conditions are very, very different today than they were in the 70s. I mean, technology is different. Demographics are different. Lifestyles are different. Real assets may not be what they were in the 1970s. We'll see. Anyway, but all of that in this program so far has been really negative. And the idea is you need to prepare for some really tough times ahead. The consumer's consumption in the United States is being driven by the top 10%. They do 50% of the consumption. If the market turns down, will they continue to spend? Probably not. Will that money flow into the economy? Probably not. That puts us into a negative return. That puts us into a recession. And at the same time, prices increasing because of tariffs and because of a lack of labor force to pick the agricultural products. It's a very negative time. But there's light at the end of the tunnel, because even as we go through that, there are going to be companies and there are going to be places to invest which do well. In any market, there's always some companies that do well. There are going to be a lot that don't do well. But during these upcoming podcasts, we're going to be talking about some of the things and some of the areas which will do well. And if you're invested in an index fund, if you're invested in some of the other things, it's a really tough time. If you go back and look at 1966 through 2000 or 1982, the stock market, the Dow reached 999.9 in the middle of 1966. Inflation was picking up, and suddenly the Dow turned over and went down 20%. It recovered and back to 1,000, and then it turned down and went down 30%. Then it recovered up to 1,000, rolled over, back down 40%. Recovered back to 1,000 and rolled over down 20%. And finally, in August of 1982, went through 1,000 for the first time and then continued to roll up to 10,000. But for a period of 16 years, the market high in 1966 was never passed. Reached again, and then it failed. Down 20%, down 30%, down 40%, down 20%. We could be looking at those kind of times again. But if you look at those times and look at what happened, there was a little tiny restaurant that was a place where there was no place to sit down, where it was a drive-up restaurant at a time when most restaurants had seating, had a kitchen that served, you ordered, and then they would send the order to the kitchen would make the food and bring it out. This was a tiny little place where they prepared everything in advance. You drove up, you bought your food and went away. That little company, 100,000 invested in a stock of that company in 1966. By 1980, that was worth $1 million. And of course, it changed. It was a lifestyle change that ended up making significant money for those who invested. And of course, the name is McDonald's. There was a company that was a radio repair shop in Colorado. All they did is repair radios. Back in those days, if you had a radio, it was worth taking it into a repair shop because they would check all the tubes, and they were tubes. in the radio. They would check the tubes. They'd find the tube that went bad. They'd replace the tube. You'd come and pick up the radio and take it away. Or you had a TV that also had tubes, big, huge TVs. If it failed, they'd go in, they'd find the repair, find out which tube was not working, replace the tube, come in and replace it. Today, if your TV fails, you go buy a new TV. Today, if your radio fails, you go buy a new radio. Not in those days. This was a little radio shop that realized the potential for the transistors, decided to set up a distribution network, began to distribute transistors and other electronic equipment. 100,000 invested in that company in 66 or 67 would have turned into $2 million, a 20-fold increase in that company. That was a change in technology that went in. There were any number of those companies that grew up in that time. So there will again be those companies that do well, even though the stock market during that period of time from 1966 went down 20%, recovered, back down 30%, recovered, down 40%, recovered, down 20%, recovered. It took 16 years for that breakout to happen. But in those 16 years, there were companies that grew tenfold. That's where you want to be. It's going to be a stock picker's market if what I'm saying comes true. And no one has a crystal ball to say for sure that it's going to happen. But I certainly believe the probability is there that it will. You know, we still need to eat even during tough times. We still need dentists. We still need doctors. We still need a number of local businesses. Clothes wear out, cars wear out. Those things tend to happen. And they tend to be valid things that money gets spent on. Even in really tough times, the economy doesn't go to zero. It goes down and it becomes a squeeze and the stock market goes down and investments go down. But the economy doesn't come to a screeching halt. If it comes to a screeching halt, we have another problem. But at that time, it's a matter of building your portfolio or finding someone that can build a portfolio that can withstand what's going on. You know, will all the investments work? No. Will some work? Yeah, some will. It's a matter of you can keep listening, you can keep investing, and keep finding those companies which will do well. The bottom line is no one knows what the future is going to bring, but it's really positioning yourself to go through a period of stagflation. And yet, if we don't have stagflation, to be positioned so that your portfolio will grow. We haven't been through times that are really tough for 17 years. A lot of people continue to see things go up and up and up and up and up. But the chances are there will be a downtime. And bear markets last about half as long as a bull market. And if that rule of thumb holds, that means we've been 17 years in this surge upward. It means the bear market that's coming is probably 8 to 10 years long. Not the 16 years, maybe, but probably not. But we're coming to a time which is going to be very difficult. So, with that said, there's a way through this. So let me ask if there's any come to talk about questions. What questions do you have?
Hey, Mike, I'm back and welcome aboard, everybody. We had a bunch of people join since the beginning. It's Chris Prouty here. I'm moderating today's workshop. And Mike, I have some questions queued up for you. For anybody else, if you have questions, we have two different ways that you can ask. You can use the webinar chat just realize that if you do send that to everyone, everyone will be able to see it. So if you want to send something that might be a little more confidential, you could send it in the Q&A, and I will not read your name if you happen to send it in the Q&A. Mike, a couple of questions that have come through, and I've had 3 people ask for a definition of stagflation. So if you could give them a quick definition of stagflation, please.
Stagflation is a period of time in the economy when you have inflation going up or at a high level, and at the same time, you have a recession or depression. So you have an economy going down with prices going up. What happens in a normal recession is that you end up with disinflation where prices are going down, the economy is going down, prices are going down, wages are going down because you have a lot of unemployment and people accepting and losing jobs, but accepting jobs at lower wages. That's the normal situation with a recession. So prices are going down and the economy is slowing down. With stagflation, what you have is prices going up with unemployment going up with the economy slowing down. That's classic inflation or stagflation.
Michael, if we do hit stagflation, how is it, how someone's asking, how is it determined? Like, does somebody make an announcement, or is it just we're in this condition? Like a season of the year, you go into fall with nobody announcing it. Is that what happens?
What'll happen is you'll hear a lot about stagflation. Already we're starting to hear some people talk about stagflation. We're starting to see that prices are not coming down to the Fed target. And last quarter, we saw a negative quarter, probably due to what was going on with tariffs and the uncertainty going on. But you'll start to see it, people talk about it if the economy starts to slow down without prices coming down. And
Mike, somebody, oh, go ahead.
by the time you're in stagflation, it's probably too late to it's never too late to respond, but the best opportunities are going to be gone.
And for those of you out there right now, Mike makes himself available for you one-on-one. These presentations that we create and deliver are intended for a general audience, but you're unique. You have a unique financial situation and a unique timeline. And so into the chat, I've placed Mike's email address. That's his direct email. You can email him right there and ask him questions. You can get on a call with him. Not a sales call in disguise. He just likes to give advice and can help you out with what questions you have about your unique situation. So his email, yeah, go ahead, Mike.
Yeah, let me give you some idea of why I feel I'm qualified. This is the return of our actual client portfolios. 500,000 invested in 2008, beginning at this up period of time, has grown almost tenfold. There's a study that was started by Moss Adams, and now is continued by Investment News. They take a survey of almost 1,000 financial advisors, large, small, and so on. And one thing that they publish a lot of information, but one thing they publish is how the clients of those firms have done. So if you look at the average financial advisor, that information is here. How they've done, that's this line. So comparing us to the average financial advisor, we do have greater volatility, but we're on our way up. And when I show a slide like that, I have to say that we have past performance is no guarantee of future performance. We compare ourselves to the Standard & Poor's, and it includes all the accounts that we manage that are stock accounts. Some that were before Adams Financial Concepts was formed, and every account that has at least one quarter. It's net of all fees and expenses. The results are net, net, net. And we also manage a profit sharing account where we share the profits, no management fee. And so those are the disclaimers. But we're pretty proud of where we're at. The cost of inaction is not being up here and is being done here. So anyway,
Thank you, Mike.
that's my own pat on my back. That's what we do.
Hey, it's well deserved. It's well deserved. Mike, somebody asks, what will be some of the first signs that the market is moving towards a bear market?
You'll start to see the market drift off. It doesn't suddenly hit one day and start going down. It starts to struggle to keep going up. You know, you can begin to see some of that maybe right now. It will continue to struggle. The fourth quarter has been a good quarter for the last few years. If the fourth quarter is not a great quarter, if January goes down, that could be an indication that we've started into the downturn. On the other hand, if January is up, if the fourth quarter is up, well, we may not see the downturn until later. No one has a crystal ball and can say. All those gurus who are predicting it, predicting up or predicting down, you know, honestly, I can't tell you when, and they can't either. So,
Mike, every week we get similar questions to these, and so I will consolidate these. But somebody says, I'm 5 years from retirement. What should I do? Somebody else says, I only have index funds. Is that enough? And that falls underneath the conversation that we had previously, which is that is a unique situation to you and would require a little bit more of a look at what you've got going on. I would encourage you to click on Mike's email address in the chat right now and just send him a quick email, and I'm sure he would be happy to give you his honest take. The next question.
Let me address the index funds.
Yeah.
If you look back in history, and history doesn't repeat, but that it rhymes. If you'd been invested in an index fund in 1966, it would have gone down 20%, recovered, gone down 30%, recovered, gone down 40%, recovered, gone down 20%, recovered. That's the index fund, the S&P or the QQQ. QQQ could be even more so. The QQQ tends to be more volatile, greater upside, greater downside. And it took 16 years to get through that period of time. Will it be 16 years? Will it be 8 years? Will it be 15 or 20 years? Who knows? Index funds are not going to be a great place to be.
Thank you, Mike. Somebody's asked about the replay of this. We always produce a replay and we upload that replay to the YouTube channel. While Mike is answering the next question, I will get that YouTube channel link and I'll put it into the chat. But in addition to that, we also send out an email with a link directly to the replay. So for those who have asked for the replay, including Elizabeth, I'll personally make sure that you get that link. And we usually have that up about 24 hours from now. Mike, somebody asks, how different is the fee management account managed differently than the split profit account?
So what we call the growth account is the account that begins for those who have 100,000 and want to grow their account at a significant level. The profit sharing account is for people that have investable assets of 1.1 million. The growth account, we charge a fee on the assets in the account so that the only way we make money is if the account grows. Increase the amount of money is if the account grows, and we charge, and we're expensive. We are very expensive because we charge 2% for the first 2 million and 1 3/4% for amounts over that. Get what you pay for. The profit sharing account, we charge no management fee we simply take 20% of the profits. And it is profits. It's not profits per quarter. We have a high watermark. When an account hits a high watermark, in order for us to get paid again, it has to exceed that and generate more profits. If that high watermark was 2 years ago, we haven't received anything for 2 years until it passes that high watermark. But we take 20% of the profits and our clients get 80%. We think it's a better deal because it's also a long short. And when we go into a time of stagflation, those accounts will also have shorted stocks, which gain when the market goes down.
Thank you, Mike, for clarifying that. Mike, I don't have any other questions queued up at this point. So why don't you give us some insight into what next week's presentation is going to be about?
Next week's presentation coming up is, are we losing the energy war? Our focus with this administration is on fossil fuels. Most of the rest of the world is focused on replacing energy, on replacement energy production, on wind, on solar, on geothermal, on the alternative energy sources rather than on fossil fuels. They're cheaper, they're repeatable, and that includes nuclear too, by the way. And they're cheaper than fossil fuels, and they're better for the environment. So let me just, an illustration I use about climate change is, if you're in your car and you drive to go to a shopping mall or shopping or somewhere, and it's 80 degrees outside, you have the air conditioner on in the car at a nice 69 degrees or 70 degrees. You get out of the car, it's parked in the sun for an hour, you come back to the car, and it's not 69 or 70 degrees. It's not even 80 degrees. Your car is 90 or 95 or 100 degrees. Why is it so much hotter inside the car than the atmospheric heat or temperature? Because the sun has been shining in, that energy has been going into your car, and the roof of your car is blocking the heat from going out. It's the same way with what happens with climate change. When you have a ceiling of methane and carbon dioxide, it's the same happening as with the roof of your car. It's continuing to heat what happens down below. Is it man-made? It doesn't really matter whether it's man-made or natural-made. We continue to pump CO2 into the atmosphere. It continues to remain. And until we take it out of the atmosphere, or until we reach a point where we capture more of the sunlight, we have climate change. Think about the droughts. Think about the wildfires. Think about what's going on in this world with climate. So anyway, that's coming up next week.
Coming up next week, for those of you who are new, this is your first week here. We present to you every week at this time, unless Mike is moderating a panel or doing something where he can't be available. So we would look forward to seeing you come back and spend time with us next week. And as I always say, your time is valuable, and the fact that you decided to spend some of it with us is really inspiring to us. And I know I speak for Mike when I say we are grateful that you were here today. If you do have questions that you want to ask Mike directly, just grab his email address from the chat and send him a quick email. And with that, Mike, I'll hand it over to you to bring us home.
So let me mention one more thing. I've mentioned past programs. You can find those on YouTube. They're in a thing called About Money. You can log in, check it out. You will receive, after this workshop, next week, you'll receive a registration which will give you the information on how to get to the podcast. Go to the podcast and sign up, because this is a difficult time for a lot of people. 11 o'clock on Thursdays. You can see the podcast anytime, and you can look back at some of the previous programs. Do go sign up and subscribe.
Mike, I just put the link to that in the
Thanks.
chat. So the link to the YouTube channel and the podcast on the YouTube channel is in the chat. So
Thanks for being here. Hopefully this is really helpful. We could be going through a very difficult time. I hope that you won't be. Have a good week, and I will be back next Thursday to talk about the energy war. Are we losing it? Have a great day.